Charlie Munger once said, "The big money is not in the buying and selling, but in the waiting." When it comes to choosing the best dividend stocks, Munger suggests looking beyond a stock's yield and instead choosing stocks with durable dividends. The idea is to invest in companies that offer a good yield and have the potential for growth and stability over the long term. Today, we're talking about 6 dividend stocks that could make you rich and provide a steady income stream for life. Before we get started, if you're new here, make sure you subscribe and hit that bell icon so you don't miss out on our next videos. Let's start with number 6, PepsiCo. With a portfolio that boasts $22 billion brands, including flagship drinks like Pepsi, Gatorade, and Tropicana, PepsiCo has literally carved out a significant space in the market. Munger, renowned for his long-term investment strategy, values companies that can generate high returns on capital over an extended period. And of course, PepsiCo, with its strong brand recognition, wide moat, and consistent performance, fits this bill perfectly. Besides, Munger always appreciates companies that have a durable competitive advantage. PepsiCo's diverse portfolio of popular brands and its global distribution network certainly provide that. The company has consistently rewarded its investors with generous dividends. PepsiCo's most recent quarterly dividend payment was $1.265 per share, made to shareholders on April 1st, 2024. If we look ahead, the company is forecasted to grow earnings and revenue by 9.2% and 4.3% per annum, respectively. This growth is actually expected to be driven by PepsiCo's continuous innovation and expansion into new markets. So, as the company adapts to changing consumer preferences and capitalizes on emerging trends, it is well-positioned to continue its growth trajectory. In a nutshell, PepsiCo's strong market position, consistent dividend payouts, and promising future prospects make it a compelling choice for dividend investors. And through the lens of Charlie Munger's investment philosophy, it's clear to see why PepsiCo could be considered a good investment. Let's move on to number 5, Costco Wholesale Corporation. Cost. It's a multinational corporation that operates a chain of membership-only warehouse clubs. The company's business model is unique and based on a membership structure. Customers pay an annual fee to shop at Costco's warehouses, which stock a wide variety of merchandise in bulk quantities. This membership model creates a stable revenue base for Costco and builds customer loyalty. Interestingly, the bulk buying format allows Costco to buy and sell products at lower prices, passing the savings on to its members. So, why would Charlie Munger be interested in Costco? Turns out he served on Costco's board of directors and owned more than 187,000 shares of Costco stock. He was a big fan of the company and loved everything about Costco and called himself a total addict. In his own words, "I wish everything else in America was working as well as Costco does." Costco has a strong history of rewarding its shareholders with dividends. The company's dividend payments per share have averaged 13.33% over the past 12 months, 13.37% over the past 36 months, 12.34% over the past 60 months, and 12.65% over the past 120 months. Do you see the consistency? And guess what? The future appears to be promising as well. The company is forecasted to grow its earnings and revenue by 7.4% and 6.2% per annum, respectively. This growth is expected to be driven by Costco's ongoing expansion efforts and its commitment to sustainability. Moreover, the company's stock price is expected to increase by 27.30% over the next 12 months, with an average analyst price target of $906.49. For the 4th stock, we have Mitsubishi Corporation. It's an enterprise that develops and operates businesses across virtually every industry, including industrial finance, energy, metals, machinery, chemicals, and daily living essentials. Mitsubishi has such a vast portfolio that it owns around 1,700 companies in 10 industries, including automotive, chemicals, food, materials, and natural gas. This diversity, which is a plus point, allows Mitsubishi to weather economic downturns effectively, as the performance of these sectors can offset each other. Like if the automotive industry is experiencing a slowdown, the food or energy sector might be performing well, balancing the overall performance of the corporation. Mitsubishi Corp fits the description of Munger's preferences for companies with a wide moat so well that he has even singled out Mitsubishi as a no-brainer pick, praising its entrenched position and its ownership of cheap assets like copper mines and rubber plantations. Last week, April 5th, 2024, Mitsubishi had a dividend yield of 5.15% and paid $1.19 per share in the past year. Now, the dividend is paid every 6 months, and the last ex-dividend date was March 28, 2024. This consistent dividend payout is a sign of Mitsubishi's profitability and its commitment to returning capital to its shareholders. And you know, it also makes the company an attractive choice for income-focused investors. The company announced its medium-term strategy called Challenge 2025, which kind of includes launching 16 new models in the next 5 years. These models will cover various segments, including ICE-powered, hybrid, and fully electric models. Interestingly, by 2030, Mitsubishi plans to invest around 210 billion yen, $1.5 billion, in 15 gigawatt-hours worth of batteries. The company targets a sales volume of 1.1 million units and an operating profit of 220 billion yen, with a 7% profit margin. So plenty of ambitious plans. Might be the best option? Next up, our third pick is JPMorgan Chase. With assets of $2.6 trillion and operations worldwide, JPMorgan Chase is a leader in investment banking, financial services for consumers and small businesses, even commercial banking and asset management. It serves millions of customers in the US and many of the world's most prominent corporate, institutional, and government clients under its JPMorgan and Chase brands. The company has a rich history that spans over 200 years, during which it has grown from a small firm into a massive and diversified conglomerate. It operates in over 60 countries with more than 240,000 employees worldwide. This year, JPMorgan Chase has a dividend yield of 2.35%. The annual dividend is $4.60, and over the past 3 years, the company's dividend has grown by an average of 4.00% per year. Munger had this extreme buy-and-hold approach. He believed in selecting only companies he felt were a sure bet, and then holding on to them for years. This philosophy is obvious in JPMorgan Chase's approach to business. Munger was known to prefer wonderful businesses at fair prices over fair businesses at wonderful prices. You know, JPMorgan Chase has strong fundamentals and fair valuation, so it kind of fits this description perfectly. It's a wonderful business because of its diversified operations, global presence, and consistent financial performance. And it's available at a fair price given its reasonable valuation metrics and the solid dividend yield it offers. Munger also believed that great investment opportunities would only come a few times in an investor's career. When such opportunities did arise, he would seize them and hold on for the long haul. JPMorgan Chase, with its consistent performance and growth prospects, represents one of these rare opportunities. Moving on to the number 2, AbbVie. If you don't know, it's a US-based company that is among the top 3 pharmaceutical companies in the world, based on sales of drugs and treatments. Back in 2023, the company made over $54 billion in revenue, a huge growth compared to $45.8 billion in 2020 and $33.3 billion in 2019. The company's most recent quarterly dividend payment of $1.55 per share was made to shareholders on February 15, 2024. The company has a pretty strong track record of 52 years of dividend increase, demonstrating its commitment to returning value to its shareholders. And let me tell you, the annualized 3-year dividend growth is 7.84%. So a clear indication of the company's consistent performance and its ability to generate steady returns for its investors. The company's blockbuster drug Humira, which treats various autoimmune conditions such as rheumatoid arthritis, psoriasis, and Crohn's disease, will face biosimilar competition in the US market, starting in 2023 and still going on. To cope with this challenge, AbbVie has made several strategic acquisitions in the past few years, such as Pharmacyclics for the blood cancer drug Imbruvica and Allergan for its medical aesthetics and neuroscience portfolios. All these deals may not be sufficient to offset Humira's commercial decline. Therefore, AbbVie may have to look for more opportunities to acquire smaller companies with promising drugs in 2024 and beyond. And yes, it also aligns well with Munger's wonderful businesses at fair prices philosophy. Next up, for the first pick of dividend stock, Charlie Munger recommends Visa. The company operates one of the world's largest electronic payment networks, with over 3.5 billion cards in use, accepted by tens of millions of merchants across more than 200 countries and territories. This vast network creates a powerful network effect, where each new user adds value to all other users. This is a key characteristic of a Munger-approved investment. Visa is a leader in a critical industry with high barriers to entry. It has a scalable business model that generates strong and stable cash flows. It has a history of dividend growth, and it has a culture of innovation. Now, these are all characteristics that Munger, and any value investor, would find attractive. One of the most compelling aspects of Visa as an investment is, of course, like we said, its consistent dividend growth. Since going public in 2008, Visa has increased its dividend every year. In 2024, they've scheduled a dividend payment of 52 cents per share. That's a pretty decent increase from the 11 cents per share they were at in 2008. They pay out these dividends every 3 months, and the last time they did was in March. So yeah, this consistent dividend growth is a reflection of Visa's strong and stable cash flows. Because Visa operates a toll booth-like business model, collecting fees on every transaction processed on its network, it generates a steady stream of cash flow. This allows Visa to return a large amount of capital to shareholders through dividends and share buybacks. Well, that's it for today. 6 dividend stocks to get rich and probably live off forever, inspired by none other than Charlie Munger. If you enjoyed the info in this video, we'd love to hear from you. Which of these dividend stocks resonated with you the most? How will you apply Charlie Munger's wisdom to your own investment approach? Drop your comments below. And if there's any topic you'd like us to cover in future videos, let us know that too. Before you go, don't forget to check out our video on 5 easy steps to go from poor to rich in 12 months. Warren Buffett. Make sure you hit that subscribe button and press the bell icon. Thanks for watching.